What's going on, everybody? Chris here from ProjectOption.com, and in this video we're not going to cover a sexy topic, but we are going to talk about a necessary topic, which is the difference between stock buying power and option buying power. So let's get started. When trading stocks or options, you have to have the appropriate amount of cash available in your account to open a new position. Now that should make sense. Now, the term buying power refers to the amount of equity in your account that is readily available to allocate to new positions. Now, before getting into option buying power, let's quickly discuss stock buying power. Now, depending on the type of account you actually have, whether it's an IRA, a margin account, or a cash account, your stock and option buying power may differ. Now, in a standard margin account, your stock buying power will typically be twice the amount of cash available in your account, as margin accounts have the ability to buy shares of stock with 50% of the position's value, and that gives you 2-to-1 leverage. Now, let's go ahead and look at a couple of various stock positions and see how much you would actually have to have in your account to trade those positions. Now, in this table, we're just looking at some hypothetical stock positions and the corresponding margin requirements for cash accounts and standard margin accounts. Now, for example, let's say you want to buy 150 shares of a $50 stock and you have a cash account. In that case, you would need $7,500 in your account to buy 150 shares of that $50 stock. Now, that's because the value of that position is $7,500. And since you have a cash account, you need to put up the entire amount of that position's value to be able to purchase that position. Now, if you have a margin account, remember I said that you could have 50% of the position's value and you could still put on that position. So since the value of a $50 share position with 150 shares is $7,500, in a margin account, you could purchase that position with only $3,750 in your account, because that is 50% of that position's value. Now, on a larger scale, let's say you have a $500 stock that you want to buy and you want to buy 1,000 shares. If you have a cash account, you're going to need $500,000 in your account to buy that position, because the actual value of that position is $500,000. Now, if you have a margin account, you would only need $250,000 to buy that position, because like I said, you only need 50% of the value of the stock position to purchase that position in a margin account. Now, that's pretty much all you need to know about stock buying power. And with that said, let's go ahead and start getting into option buying power, which is a little bit more complicated. Now, unlike stocks, options cannot be purchased on margin, at least not in most accounts. Now, option buying power is equal to the amount of equity in your account that is readily available to allocate to option positions. Now, let's go ahead and run through multiple examples so we can cover all the bases and see what this actually means. Now, the first example we're going to go through is buying a call option in Apple. Now, let's say this call option is worth $1.25. To buy that $1.25 equity option, you would need $125 plus your commission rate in option buying power to execute that trade. Now, that's because when you buy options, you have to put up the total amount that you can lose, and in the case of buying an option, the most you can lose is the premium that you pay. So if you buy an option for $1.25, the actual value of that equity option is $125, because equity options have a standard contract multiplier of $100, which is because most equity options represent 100 shares of stock. Now, since this particular Apple call option is trading for $1.25, you would need $125 plus the $1 commission rate in this example to purchase this option. So all in all, you'd need $126 in available option buying power to purchase this option. Now, the same concept is true for any option spreads that you purchase. So in this example, we can see that we're buying an Apple put spread that is $10 wide, and we're purchasing that put spread for $2.38. Now, as we just discussed, that $2.38 premium actually represents $238 of value. Now, since there's two options in this spread and there's a $1 commission rate per option, we would need a total of $240 to purchase this Apple put spread. Now, the bottom line is that when you buy option positions, you need to have the entire loss potential covered in available option buying power to actually put on that position. So now that you know how to calculate the buying power requirement for buying options, what about selling options? Now, when it comes to short option positions or option positions you sell, the same concept is true for limited risk spreads. To sell the option spread, you need the entire loss potential available in option buying power to trade that position. Now, let's go ahead and look at a quick example. Now in this example, we're going to look at a $10 wide put spread in Netflix that is trading for $2.74. Now if you sell a $10 wide spread for $2.74, the most you can lose is $7.26 because a $10 wide spread can only appreciate to $10. And if you lose $7.26 on an option, that's an actual loss of $726 in actual dollar terms. Now, in this hypothetical example, the commission rate is $1 per contract, and since there are two options in this put spread, the commissions come out to $2. So, all in all, we'd need $728 in available option buying power to sell this spread based on that maximum loss of $726 plus the $2 in commissions. Now when it comes to selling naked options, which is selling a call or selling a put without any protection against that short option, the industry standard is to use the greatest of three calculations. So the first is 20% of the stock price minus the out of the money amount of that option plus the current value of the short option. Now the second calculation differs between calls and puts, and for call options it's 10% of the stock price plus the current value of the call option. And for put options, it's 10% of the strike price plus the current value of the put option. And the third calculation is $50 per option contract plus the current value of the short option. Now don't worry, you won't ever have to calculate these by hand as your brokerage firm takes care of it for you in real time. However, let's go ahead and look at one quick example just to show you how that margin requirement would be calculated. Now as an example, let's look at the estimated option buying power requirement for a put option on a $100 stock. Now let's say the put's strike price is $90 and that put is trading for $2.50. 20% of the stock price would come out to $20 and that put strike price is $10 out of the money since the stock price is $100 and the put strike price is $90. So we would subtract that $10 out of the money amount from 20% of the stock price, which gives us $10. Now when we add the put's price of $2.50, we get to $12.50, and then we multiply that by 100 to get $1,250. Now the second margin requirement calculation would be the put strike price times 10%, which is $90 times 10%, or $9, plus the put's price of $2.50, which comes out to $1,150 when multiplied by 100. Now the third margin calculation is $50 per contract plus the put's price times 100, which comes out to $300. So obviously the greatest of those three calculations is the first calculation, which comes out to $1,250. And that is the estimated margin requirement that you would need in available option buying power to sell that put option at a strike price of $90 that's trading for $2.50. Now the last thing I'll mention is that option buying power does change in some cases. For limited risk positions, your option buying power will not change because the risk of that position does not change. However, for naked short option positions such as short calls or short puts, the buying power requirement will change as the stock price, option premium, and out of the money amount change, so just keep that in mind. Now with that said, it's never a good idea to max out your account in buying power, as an increase in margin could force you out of the positions at the wrong time. Now, in fact, if you can't cover your margin requirement, your brokerage firm could just close your positions for you, so that is just something to keep in mind. Alright, well we've covered a ton of content in this video, so let's go ahead and do some quick concept checks to quickly recap what this video talked about. First and foremost, stock buying power is the amount of equity in your account available for stock purchases. Now, in margin accounts, your stock buying power is typically twice the cash available in your account, as standard margin accounts can do 2-to-1 leverage, which means you can purchase option positions for 50% of the actual value of that stock position. Now for limited risk option positions, such as buying calls, buying puts, buying put spreads or call spreads, or selling those spreads, the required option buying power is equal to the position's maximum loss potential plus commissions. And lastly, when selling naked option positions, such as short calls or short puts, always keep a portion of your account in cash, as the margin requirement for these positions can increase and potentially you could get squeezed out of those positions if you don't have enough capital in your account to cover that margin requirement. Thanks so much for watching this video, everybody. I hope you enjoyed it. If you did, please go ahead and give this video a like, subscribe to our channel, and also feel free to check out some more of our videos by clicking on that video link on the right hand side.